Good evening from New York. It's 5:51 p.m. on Wednesday, April 15th, 2026. Welcome to the Lynx Data Insight Market Briefing. This analysis is AI generated by Lynx Data Insight and is for informational purposes only. It does not constitute financial advice. The U.S. stock market is currently closed, and what a session it was. We've got new all-time highs on the S&P and NASDAQ, a divergent Dow, and a fascinating tension between what the headlines are celebrating and what the breadth data is actually saying. Walk us through the numbers.
Let's anchor this immediately. The S&P 500 closed at 7,022.10, up 0.79%. That is a new all-time high, surpassing the prior record of 6,979 set on January 27th. The Nasdaq Composite finished at 24,010.78, up 1.57%, also an all-time high, eclipsing 23,958 from October 2025. According to Nationwide's Mark Hackett, that is 10 consecutive days of gains for the Nasdaq, the longest streak since 2021. Now here's the divergence. The Dow Jones fell to 48,460.55, down 0.16%, weighed down by price-weighted laggards like Goldman Sachs and Caterpillar. The Russell 2000 added 0.29% to close at 2,713.62. The VIX sits at 18.17. The 10-year Treasury yield is 4.28%, the 2-year at 3.61, giving us a normal yield curve with a 67 basis point spread. And here's the critical data point. The advanced decline ratio was 258 advancing to 269 declining. More stocks fell than rose on a day both major indices hit all-time highs. That tells you this rally is being led by a narrow group of mega-cap names, not broad participation. We're in a momentum-driven, large-cap-led regime where the index-level signal and the underlying market health are sending contradictory messages.
That advanced decline split is striking. New highs with net decliners. So what's actually driving this? It can't be one thing.
Three catalysts converging. The primary driver is a blockbuster bank earnings cycle validating economic resilience. Bank of America reported first-quarter profit of $8.6 billion, up 17% year-over-year. J.P. Morgan's fixed income trading revenue jumped 21% to $7.1 billion, their second biggest quarter ever. Morgan Stanley's bond trading surged 29%. Citi's bond trading climbed 13% to $5.2 billion. Every major bank except Goldman Sachs delivered a beat in fixed income, and their executives uniformly described the underlying economy, consumer and corporate, as resilient. The secondary catalyst is a growing Wall Street consensus that the Iran conflict will de-escalate. President Trump said on Fox News Wednesday that the fighting is very close to over. Wells Fargo's Scott Wren expects the conflict to continue for weeks, not months. That ceasefire expectation is triggering a rotation out of energy hedges. APA Corporation fell 6%, Occidental Petroleum dropped 4.5%, ConocoPhillips declined 3.91%, and into growth and tech. The third catalyst is Tesla, which surged 6.88% to $392.03 after Elon Musk announced the AI-5 chip reached a key engineering milestone. UBS flipped its rating from sell to hold with a $352 price target, and the company launched its spring full self-driving software update. That 12% plus weekly rally in Tesla is lifting the cap-weighted indices disproportionately.
But the Goldman Sachs fixed income story is almost more interesting than the winners. How does a firm with that pedigree miss by $910 million while everyone else posts blockbuster numbers?
It's structurally significant because it reveals exactly how the rates repricing caught positioning off guard. According to CNBC, the prevailing theory is that Goldman was caught offsides on interest rate trades. At the start of 2026, the market was pricing at least 2 Fed rate cuts. Then the Iran war sent oil surging, inflation expectations spiked, and those cuts got priced out entirely. Some investors now brace for possible hikes. Goldman's fixed income desk was apparently positioned for the rate-cutting world, and the reversal inflicted real damage. Wells Fargo analyst Mike Mayo called it worst in class. What makes this a market signal rather than just a Goldman story is that it demonstrates how violent the rates repricing has been. If one of the most sophisticated trading operations on Wall Street got caught offsides, you can be confident that plenty of institutional portfolios are still mispositioned for this new rates regime.
That connects directly to the Fed question. The 2-year at 3.61 suggests the market still expects the Fed is done hiking, but the inflation picture is getting messier. What does today actually change about the rate path?
The 2-year yield at 3.61% is essentially a proxy for where the market expects the Fed funds rate to settle. It sits well below the 10-year at 4.28, producing that normal 67 basis point spread, which tells you the bond market is not pricing a recession. It's pricing an economy that can handle current rates. But here's the tension. At the start of the year, that 2-year was pricing in at least 2 cuts. The Iran war's oil shock has driven what CBS News calls the hottest inflation in nearly 2 years. According to AAA data cited in the Chevron report, the average gallon of gas is now $4.12, up from $2.98 just before the war. That is a 38% increase in energy costs hitting the consumer. Layer on top of that the CNBC report on cattle. Live cattle futures settled at $2.51 per pound, a record going back to the 1960s, according to CME and FactSet data. Ground beef hit about $6.70 per pound in March, up roughly 12% year over year per the BLS. When you have energy and food simultaneously at multi-year or record highs, headline inflation stays elevated. Now, the Fed typically looks through energy shocks unless they contaminate core inflation or unanchor inflation expectations. We're not there yet, but the transmission mechanism is active. Energy costs are flowing into fertilizer prices. Nearly 60% of farmers told the American Farm Bureau their finances are worsening, which feeds into food prices, which hits consumer spending power. For now, the base case is the Fed holds through at least mid-2026. The next move depends entirely on whether a ceasefire normalizes energy prices. If it doesn't, and energy remains elevated for 2 or 3 more quarters, core inflation will absorb some of that pass-through, and rate hikes come back on the table.
So, who are the clear winners and losers from today? Let's get specific.
On the cyclical winner side, DoorDash led the S&P gainers, up 8.67%, benefiting from the broad risk-on rotation into consumer delivery platforms. Datadog gained 6.23% as the AI and cloud infrastructure momentum trade accelerated. AppLovin climbed 5.82% in the digital ad tech space. Coinbase rallied 5.56%, Goldman Sachs filed for a Bitcoin Premium Income ETF, the SEC eased day trading rules, and crypto sentiment is running hot. And Robinhood, according to the Motley Fool article, surged 10.48% to $87.38 after the SEC scrapped the $25,000 minimum margin requirement for day trading. That change is structurally significant for retail-facing brokerages. Charles Schwab gained 1.98%, Interactive Brokers rose 3.36%. For structural winners, look at financial services. 83.72% of stocks are above their 50-day moving average, 43.22% are near their 52-week highs, and only 3.04% are near lows. That is the strongest breadth reading in the entire market, validated by the earnings cycle we just discussed. Utilities have the highest percentage near highs of any sector, at 53.03%, with only 1.52% near lows. That's a defensive positioning signal. Real estate is quietly strong at 70.73% above the 50-day, 42.07% near highs. Now, the losers. The industrials cluster is unmistakable. 6 of the top 10 losers are industrials. Carrier Global down 8.51%, Stanley Black & Decker down 6.41%, Lennox International down 5.98%, Ingersoll Rand down 4.91%, A.O. Smith down 4.12%, and Wabtec down 3.46%. That is a broad-based margin compression story hitting the real economy. Consumer defensive carries the worst stress reading in the market. 10.71% of stocks near 52-week lows, the highest of any sector, with only 42.98% above the 50-day. That is a $3.69 trillion sector being quietly crushed by food and energy inflation. And technology is bifurcated in a way that matters. 59.1% above the 50-day sounds decent.
Wait, that bifurcation in tech deserves attention. You've got Apple up 3.2%, Microsoft up 3.37%, NVDA up 1.18%, all pushing the Nasdaq to records, but nearly 7% of the tech sector is near 52-week lows. How should investors think about that gap?
It's the defining feature of this market regime. Let me give you the Magnificent Seven profile. Apple closed at $266.37, up 3.2% on the day, but still essentially flat over 5 days, down 0.03%, and down 4.4% year-to-date. It's trading just above its 200-day moving average of $250.89, but hovering right around its 50-day at $260.86. Microsoft closed at $411.27, up 3.37%, with a strong 5-day return of 5.02%, but is still down 16.69% year-to-date and trading well below its 200-day moving average of $471.56. That tells you Microsoft has been deeply damaged this year and is attempting a recovery from a significantly lower base. Alphabet is the cleanest story. $337.15, up 1.28%, trading well above both its 50-day at $307.59 and 200-day at $270.58, up 5.72% year-to-date. It's the structural leader. Amazon at $248.41 was the lone decliner, down 0.32%. And this is where the seller boycott story is directly relevant. Over 700 large sellers organized a 24-hour advertising boycott today to protest Amazon's new 3.5% fuel surcharge and payment policy changes. According to CNBC, Amazon's average cut of each sale has already crossed 50%. Those margin pressures on the marketplace ecosystem are a headwind for Amazon's seller services revenue, which is 42% of total sales. Despite that, Amazon's 5-day return is a robust 12.55%, so the market is giving it the benefit of the doubt ahead of earnings.
All of that feeds into the Rystad Energy report on infrastructure damage. $58 billion is an enormous number. How does that shape the risk case?
Let me lay out both scenarios with probabilities. Our base case, which we'd assign about a 60% probability, is that the ceasefire consensus holds. The S&P 500 trades in a range of 6,950 to 7,120 over the next week. The 10-year yield stays in a range of 4.20 to 4.38%. Oil drifts lower on de-escalation hopes. The Fed holds through mid-2026. The narrative here is that strong bank earnings validate economic resilience. The ceasefire materializes in weeks, not months, as Wells Fargo expects. And big tech earnings next week, Alphabet, Amazon, Apple, Microsoft, all reporting, provide the next upside catalyst. The risk case, which we assigned about a 25% probability, is an escalation trigger. Rystad estimates up to $58 billion in energy infrastructure damage, with a minimum $34 billion repair bill. The IEA warns restoration could take 2 years. More than 80 facilities have been attacked, and more than a third are severely damaged. If the Strait of Hormuz remains blocked or new attacks hit Gulf facilities, oil surges sharply higher. Here's the causal chain. Sustained energy price shock pushes gasoline well above $4.12, which drives headline CPI higher, which feeds into food costs. Fertilizer up, cattle at records, farmers unable to afford inputs, which compresses restaurant margins, forces Amazon sellers to raise prices, crushes consumer discretionary spending, and ultimately forces the Fed to at least consider rate hikes. In that scenario, the S&P 500 could retest 6,500, the 10-year yield could push toward 4.60%, and the narrow advanced decline breath we're seeing today would become a full market correction as the mega-cap leadership can't carry an increasingly stressed underlying economy. The upside tail, roughly 15% probability, is a formal ceasefire that reopens the strait, collapses oil prices, reverses the inflation overshoot, and reopens the path to Fed cuts in the second half of 2026. Combined with blowout big tech earnings and AI capex narratives, Alphabet guiding to $175 to $185 billion in 2026 capex, Amazon approximately $200 billion, Microsoft nearly $30 billion per quarter, you could see the S&P 500 push towards 7,400 to 7,600, which aligns with Wells Fargo's year-end projection.
Given those probabilities, how should investors actually position?
Highest conviction financial services. Maintain and gradually increase exposure. The sector breadth is unmatched, 83% above the 50-day average. The earnings validation is clear, and they benefit in a higher-than-longer rate environment. Secondary conviction, mega-cap tech with AI capex visibility, specifically Alphabet and NVDA. Alphabet is trading above both moving averages with the strongest year-to-date profile of the Mag 7. NVIDIA at 198.87 is above both its 50-day of 182.38 and 200-day of 181.31, with an 8% 5-day return. Both are positioned to benefit regardless of the geopolitical outcome because AI infrastructure spending is running on its own cycle. Tactical trade, Robinhood and the retail brokerage complex. The SEC's elimination of the day trading minimum margin requirement is a structural regulatory shift that permanently increases the addressable market for retail platforms. Avoid list, industrials broadly. That 6-name cluster in today's losers is not noise, it's a signal of margin compression from energy and materials costs. Consumer defensive names near lows. That 10.71% near lows reading is telling you the market is telling you staples producers are absorbing input cost inflation they cannot pass through. And be cautious on energy producers. The ceasefire trade is actively unwinding energy hedges. If de-escalation continues, APA, Occidental, and ConocoPhillips have further downside, even though the infrastructure damage creates a structural floor for prices over the medium term.
How does it all fit together?
When you step back, this is really about a market that is pricing a best-case resolution to the Iran conflict, while the real economy is still absorbing the worst of it. The S&P 500 at a new all-time high tells you the market believes ceasefire is coming and earnings are resilient. The advanced decline ratio of 258 to 269 tells you the average stock disagrees. The consumer defensive sector's 10.71% near lows reading and the industrial sell-off tell you that energy and food cost inflation is compressing margins in the real economy right now. Ground beef up 12%, gas up 38% from pre-war levels, 60% of farmers saying their finances are worsening. The disconnect is time horizon. The equity market is trading on a 3 to 6 month forward view where ceasefire normalizes prices, while the real economy is living through a present tense cost shock. The alternative view, and this is a genuine argument, is that the bank earnings prove the economy can absorb this energy shock without breaking. Consumer spending has held up, credit quality is intact, and if the ceasefire materializes as Wells Fargo expects, the drawdown in energy costs would function as a massive tax cut for consumers, reigniting spending and justifying these index levels. The CFTC's investigation into suspicious pre-announcement oil trades adds a wild card. If the integrity of energy price discovery is compromised by information leaks, it could accelerate the very de-escalation timeline the market is banking on.
3 takeaways to close us out.
First, the risk. The advanced decline ratio is your early warning system. If the S&P 500 continues making new highs with net decliners, you are building a market that is structurally vulnerable to a catalyst that hits the mega-cap leaders. Monitor breadth daily. Second, the insight. Goldman Sachs's $910 million fixed income miss isn't a Goldman story, it's a market positioning story. It tells you the rates repricing from the Iran war caught institutional portfolios offsides, and that process may not be finished. The 2-year at 3.61 still reflects some residual easing bias that may need to be unwound if energy prices persist. Third, the positioning idea. If you believe ceasefire is the most probable outcome, and at 60% probability it is our base case, the highest reward trade is adding to Alphabet and NVDA ahead of next week's earnings, paired with a reduction in industrials exposure where margin compression is already visible. The sector breadth data gives you permission to be selective, own what the market is rewarding, and avoid what it's quietly punishing beneath the index-level headlines.
Thank you for listening. This is Lynx Data Insight, and we will be back tomorrow with your next market briefing.